I'm considering the fact that investments is inherently risky, just like all other fields of human enterprise. These are fraught with risk. Do you stay away from investments? No. Do you run away from the stock market? No. What do? You consider the risk and see how you could mitigate those risks. So in this video, I want to talk about how to manage investment risk and build your wealth wisely. So number one procedure here is understand risk and return. You must understand the nature of the risk and then the return attached to the kind of risk you want to take. So recognize the risk return trade-off and align it with your investment objective or goals. Understand types of risk, maybe market risk, credit risk, liquidity risk, inflation risk, maybe interest rates, risk. I have a video on a different kind of risk, investment related risk. You could check the video in the channel to understand risk at a deeper level. Number two is diversification. You spread your investments across different asset classes, different asset classes and different sectors, different industries, and to reduce risks. And sometimes you can even invest outside your home country. You could equally employ a mix of stocks, bonds, real estates, and alternative investments into your portfolio. That will go a long way to mitigate risks, because the performance of these assets most of the times do not correlate. Okay, so that will help you to mitigate risk in the market. Number three is asset allocation. You allocate your portfolio based on financial goals, based on your risk tolerance and your investment horizon. You rebalance periodically to maintain your desired allocation. So when it comes to asset allocation, you allow your risk tolerance to determine it. You allow your investment goals to determine it. If you are a long-term investor, you may incorporate, bonds into your asset mix. But if you really want to, you're looking for higher returns, you could go for an equity-only portfolio. That will give you the level of growth you want to accomplish. Number four is conduct due diligence. Conduct due diligence. Research and analyze potential investments thoroughly. Understand financial health, management, and industry trends. So you should be able to analyze the company's financials, thoroughly. You also look into the management team, their track records, the efficiency, the alignment with shareholder values, and all those and other related factors. Number five is have a margin of safety. Invest with a buffer between the purchasing price and the intrinsic value, of the company, to protect against losses, or to protect against error in analysis or error in judgment. If you believe a company is worth $10, you don't buy it for maybe for $9 or $11. No, the lower the price, the better. Maybe 5 or 6 or 4 is better. So you have a better margin of safety. So in case you made a mistake, you will not lose much as such. And if you are right, in the future you are bound to make an enhanced level of returns. So you consider a margin of safety. Number 6 is manage emotional bias. Usually when it comes to investing, human beings are not always rational. No, they are not. That is why the efficient market theory is not really applicable in the short term, because individuals tend to be ruled and governed by emotions, fear, greed, panic, and all other psychological behavioral biases come into play when it comes to investing. So you try to manage your emotional bias to be able to have the level-headedness, the calmness to make well-informed, excellent investment decisions. Number 8 is, or number 7 rather, is use stop loss order and hedging. You use stop loss. Stop loss here means that when you fix a stop loss price. That is, the price will not go below that particular price. If your stop loss is let's say $10. By the time the stock gets to $10, automatically the system will then dispose the shares, will sell off the shares, so that you will not end up, selling at below at $10. So you incorporate stop loss, and also incorporate hedging. Hedging here, hedging kind of helps you mitigate risk. If you have long positions, you can equally hedge by having short positions in your portfolio, so that if your long position does poorly, your short position will compensate for the poor performance of your long positions. Number 8 is monitor and review investment regularly. When you invest in a company, you don't go to sleep. You continue with the work, you continue with the research, you continue to monitor your investments regularly to see whether you will need to buy more of what you've invested in, or you will need to sell, part of what you've invested in, depending on how the companies perform. So you review your investment regularly. So you adjust based on market condition, personal changes, and portfolio performances. Number 9 is understand liquidity needs. You need to understand liquidity, because sometimes, there could be need for you to sell your stocks. So how liquid is the stock? All right, you want to dispose the stock, and then how liquid it is. Can you easily sell, dispose the stock in the market? So you consider liquidity. You may have need for short-term emergency, maybe cash. So will you be able to raise that money very easily in the market, considering the nature of stocks you're holding in your portfolio? So liquidity is very, very important. Number 10 is use professional advice when needed. No man is an island, no matter how experienced you are. Personally, I've spent 18 years in the market, 18 years investing. Others have spent 20, 30, 40, even 50 years and above. So I can learn from them. Men like Buffett, people like the late, Charlie Munger, people like Peter Lynch, people like, Howard Mark, people like, there are just many, all those gurus in the investment field. You can learn from them. They can act like you are informal professional financial advisors. You don't want to pay for one. They could act as your mentors. Number 11 is limited leverage or limit leverage. Limit your exposure to leverage. Don't borrow too much. Don't become over leveraged, because it will magnify your losses. All right. So if you must borrow, make sure that you borrow what you could manage as little as possible. That's if at all you must borrow to enhance your portfolio. So limit your exposure to leverage. Number 12 is have an exit strategy. Before you buy a stock, have an exit strategy. And what is your exit strategy? You say, well, this stock I'm buying, if possible, put it down in writing. If it gets to this particular price, I may sell. Or even the company finances takes, a nosedive, you could be prompted to sell. If the narrative surrounding your investment changes, you shouldn't hold on to that particular stock. You are expected to sell. So have an exit strategy. What is my exit strategy as regards to this particular fund, this particular company I have in my portfolio? Before you buy, know why you should sell. Sometimes it's very difficult to sell than to buy. So make sure that you take all this into consideration.